Hi, I'm Miko.Nehman with Century 21 Hometown Realty.
And I'm April Hugh. I'm with Century 21 Hometown Realty. And today we have Lee Carroll CPA here visiting with us. And we're going to touch on quite a few things today, Proposition 19 being one of them. So,
Yes. Welcome.
Yeah, welcome.
Thank you. Good to be here.
Yeah.
So,
Can you kind of give us a breakdown of the pros and cons of Prop 19?
Sure. And before I even start anything, though, I wanted to mention a letter on the Board of Equalization website that they put out on December 11th of last year that talks about that there's a lot of uncertainties in this proposition and that many things are going to be decided in the courts or via further legislation, which is what we deal with in CPA, my world, all the time when it comes to new tax law. And when tax law first comes out, we don't know exactly how to interpret. Sometimes it's certainly black and white,
Right.
but there's many areas that are gray. And we don't know how to interpret it, and we'll take it to a certain direction and run with it, and then it'll go to tax court, and then we'll figure out we did it right or we did it how they didn't intend it. So the same thing goes with this Prop 19. There's a lot of area that no one's sure of yet. And in fact, we'll get to it when I talk about that. And then another thing I'd like to, before we get going, I'd like to give a proper shout out to the assessor's office, county assessor's office. When I called them to inquire on to get information after the research that I had done, and not only did they call me back, I think it was a woman named Seda, I think it was, called me back very promptly. She was kind, professional, knowledgeable, helpful, gave me more information than I asked for, and it was just, I was so pleasantly surprised. I was amazed. Normally with government employees, you figure you're going to call them 5-6 times. No, they called back right away, and I really appreciate the service. So.
that's a good tip. Yeah.
I was very surprised. So the pros to the deal, pros to the 19, and if you get to me, if you ask me, I guess part of this is my opinion. So I'm not sure that we all knew when Prop 19. I don't know if we researched it well enough or what, but I don't think it's very good for the most of us. For the firefighters, it's a good deal because there's going to be money going to the firefighting. But so the pros. The transfer basis, so anybody, if the older generation, 55 and above, and so there's severe disabilities, and if we lose our home in a natural disaster, we can transfer the basis of the home that we had into a new home. So the best example is the fire, is that if we lose a home in a fire, what would happen is they build a new home, and their basis in the new home would be whatever it cost. So the taxes they were paying would be on that, how much they paid for it then, not what they had before. Now, if you lose a home that you paid $50,000 for, and you rebuild it for $250,000 or $600,000, your basis will still be $50,000 with this thing. So your taxes you're paying on are $50,000. It's the same thing for a person with severe disabilities, and those of us that are over 55 years old. It used to be you could only do it once. And you can only do it in certain locations, certain counties.
Certain counties
participated in California. Now the entire state counts, and you can do it 3 times. So you can, and the intent, as I understood it, was to people exactly like me, actually, to have the kids gone. I have a 4-bedroom house. I don't really need to live in a 4-bedroom house, but I don't want to go buy a smaller house for $2 million and pay taxes on it. So I'll stay in the house I bought 25 years ago and they want me to go to buy a smaller house and let other people come into this one, and the tax revenue goes there, and I keep my basis, and that was the original intent as I understand it. So that's a pro. Up to 3 times I said. Also, you can blend the value, so there's a meaning that up to $1 million, it's not free and clear. If I transfer, let's say my basis is $500,000, and I can get any house up to $1.5 million. And I keep my basis. If it's $2 million, then my basis it'll be the higher amount minus $1 million. So if I buy a $2 million house, my new basis will be $1 million. I don't know how the logic or the mathematics. I don't know. You understand probably because you do this stuff. So I hope that your listeners follow me on that.
Well, yeah, it's yeah. Mm-hmm.
The negatives, I think outweigh. And I think it comes up, I think you have it later, we talk about, they're calling it the Lebusky Loophole.
Right.
And in that movie, there was a guy, I haven't really seen the movie, but when I was doing my research on this stuff, there's a guy in that movie who owned a property in Malibu that his parents had bought in the 1950s.
Right.
And so he was paying taxes on 1950 property in Malibu so he was really getting over. So that's what they're trying to close up, or something along those lines. But what's happening, in my opinion, is that, now, so if it used to be that if the parent dies, the house would go to the kid at the basis that the parent bought it at, right? Whatever the basis transferred to the child. Now, there's a couple of things involved. If the basis will transfer to a degree to the child, but the child's got to live in the house. The child has got to move and make that their primary residence. And here's where Seda, the woman from the assessor's office, really helped me out. That's why I called her. I looked everywhere. How long do you got to live in the house? Like for the exclusion that we're going to talk about perhaps later, you got to live in the house 2 of the past 5 years. There's little. IRS always has a statement of time before you qualify, and if you do the before then, there's a penalty to pay. So I asked Seda, I said, so how long? And she said they have to live in the house. And I go, well, yeah, it has to be their primary residence. How long do they have to live there before they can do anything different? And she said forever. They've always got to live in that house.
So they can't even sell it?
If they sell it, sure. I mean, they can sell it, and their basis would be that. But if they move out of it and start renting it, then and that's what Seda, the woman I hope I have her name right, but she's saying that's what they don't know how they're going to have their enforcement of that. And it's going to have to be like IRS audits. It's going to have to be where you just randomly pick a house and they'll go check and make sure they're still living in it. There's no other. That's what I think.
Well, I also maybe think they need do a little modification on that as time goes, and where just because just
doesn't make any sense yet.
Further legislation.
More monitoring than
You're
that
right.
probably wants to do.
Or see, that's the further legislation that letter talks about. Later on, as they've realized these things, one thing too that I don't know if want to mention too is that $1 million exclusion, it's going to be every February 16th of every year. It's going to be adjusted for inflation. So next year it'll be $1,016,000 or whatever, and then it'll go every year on February 16th is the date they recalculate it at. So.
Very interesting information there, Lee.
But the other part of it on the negative side is anything other than your primary residence. So before is, well, I don't want to go into before, anything other than the primary residence. So if the parents have a cabin up in Big Sur, right, that gets automatically reclassified and you're paying taxes at the new level. So
At the time they die.
that part I'm not sure. It might go. I don't know if it's going to follow that or currently you can have that or you can have the date of declaration, which can be up to 6 months later. And I don't know the answer to that. It's not going to be much of a variance either way, but there are reasons why. And that's in estate planning, where at the date of death, or you can do it. What's it called? The executor can choose to do it 6 months later. I've forgotten the names of the dates, but what they're called, they have names. But you can sometimes. But I don't know in the Prop.19. I don't know how it's.
So now, so they're basically saying if you inherit a house and you don't want to plan on moving in there as your primary, then sell it. I mean, you're going to also pay taxes on that a lot more than you would normally. But so they're generating some revenue with this whole thing for was it CAL FIRE? That's
Think if it's 10% more than what they planned, anything more over and above that, they can give it to any part. Or I shouldn't say any. They can give it, as I understood the article, they can give it to any other area in the government or the other.
That's neat.
There's a certain amount that has to go to fires, and if they get more than that, they can distribute it to other places. But the example I read was, I don't remember all the details, but it was the 2 homes. It was a home, a primary residence, and a rental property, 500,000 basis, both of them. And so the annual tax for each of them was $12,500 for the parent. All right, the kid inherits it, and then it's $3 million for the home and $2 million for the rental property is the basis or the fair market value at that time. And then they showed the calculations so that what had been paying $12,500 a year in property taxes went to $50,000 a year for $25,000 each for those 2 properties. So. It's a big jump.
That's
huge.
That's money. That's a lot of money.
Another example they used was up in San Francisco, an apartment complex that was purchased in the late 70s for $2 million. It's now worth $20 million. So the amount of increase in taxes on that is going to be insane.
Yeah, and it's hard for anyone to be able to pay that amount of money and keep it. Right. So, okay. So we covered that. Now, I mean, I had, some people, since our last meeting, I had some people reach out to me and, ask me these questions, should we, are there any exemptions? Should we form an LLC or a irrevocable trust? Is there anything else that can be done to avoid these tax, I guess, penalties or increases?
Paying the
Yeah,
higher taxes, yeah.
That you know of, or is that just not?
Well, the exemptions, remember, there's that 1 million that goes, and the other thing that I don't think we talked about yet, but there is, so we're talking parent to child, right?
Yeah.
And there's a grandparent to grandchild, but from what I read and understood, that's only if the interceding parent is passed. So the grandparent can give it to the grandchild if there's no parent in the middle.
Okay, that makes
Otherwise, it's got to go to the parent, so they can't skip the generation. And that's important, because the grandparent might, who knows what the reasons would be. As far as LLCs and other entities, what I saw, I tried to research that. I really did, to see what about doing that. And every area I went, and I spent a lot of time on this, said, see a lawyer. Said, see a lawyer.
Okay,
Talk to a lawyer.
Really?
That's what it said, yes.
Yeah, it's more their classification because it's the legal trust or.
And the trust, when does it what was it? They called it a window or a veil. There's a legal term of when did ownership transfer, and I forgot what it was. But in a trust, it's different, especially if more than one person owns it, right? And also in an LLC, if there's more than one person in it,
Gotcha.
But again, there was no definitive do it in an LLC and you'll score.
Right.
None of them said that. They all said talk to a lawyer.
Talk to the lawyer.
Mm-hmm.
Okay.
Can we backtrack a little bit? I sent you the email about the form to be filled out. Now, do you help people with that form, or are they just basically on their own to do it with your clients?
If anybody came to me, I'd help them with it for sure. I mean, that's part of my. I would think part of my services is as far because it's not a whole lot of, it's not that difficult if you're a numbers person, right? It's not, and you have the data. If you don't have the data, it's a problem. Kind of like finding basis for stocks or whatever. If you don't have it, but for the home, they know generally what they paid for and all the stuff, something like that. I do it just as part of,
Right.
yeah.
Okay.
I think anybody would probably.
I was just, I
great.
wanted to double check because I was telling my clients to go see their CPA. So I just
Well,
wanted to make
and-
sure that was
yeah.
the correct thing to be doing if they need a little hand.
Well, very good. That's good, some good information. And now what about selling a personal residence? If you own it, your primary residence, and you own it for less than 2 years, and then you decide to sell it less than 2 years, and there's definitely you're going to, profit some money. Is there a way, like exemptions not to pay capital gains, or do you know some of those reasons? Can you?
Definitely, and it's funny because the last time we talked, I knew some of them, but so I'd done some reading. In fact, I printed it out. So the work-related move, we knew that one. I said that one last time, and a lot of times for us, it's Vandenberg people.
Okay.
They get transferred. So if it's a work-related move, you're good to go. Health-related move. So if you need to sell your house to move to LA or to, Stanford Clinic or whatever to be with a loved, whether you're sick or you're visiting a relative, whether you're doing it to care for or support a relative,
Right.
that works. Unforeseeable events. So the stuff going on in Texas, no one saw that coming. So if the water pipes bust and you're just done, I think that would qualify. Then you'd only live there a while. You could say, I don't want to, I guess maybe Texas wouldn't be a good example because that only happens. But still, that was one of the other ones. Your home is destroyed or condemned or casualty loss. You, your spouse, are the co-owner of the home. And then, of course, there's death, which we didn't talk about last time. If you co-own it with somebody and the person, like a spouse, I guess, and the spouse dies, that qualifies as an exemption. And then they cover everything. They say other facts and circumstances. And so even if your situation doesn't match the standard requirements, you still may qualify for an exemption. And then it lists, it was unforeseen for circumstances that you can argue why I'm selling it underneath the 2-year time. So, and I know I've had a couple of those, like 3, and I've been doing taxes for 20 years, and I think I've had 3 of those that I've done and had no problem with it. No, it never came back, and no, not a problem.
Good. Very good. And I guess one of the last topics I was hoping you could share a little bit was about the COVID relief in filing taxes this year.
The thing, the good news, I don't know, to me, the COVID, the simple COVID for folks like us with no employees and whatnot, and you're talking just in general,
Yes.
When you file your tax return, it's going to want to know whether you go to your CPA or whether you do it on QuickBooks, or no, whatever, TurboTax. It's going to ask you, did you receive the first and the second stimulus? And then you'll say, yes, I did, or no, I didn't, or yes, I received one, and no, I didn't receive the other one. And then you'll get 0 right now. But I have one client that got neither. So she got, and I just filed her return a couple days ago. So she got neither the first one nor the second one. Doesn't know why, because she filed her tax return with a direct deposit. So it seemed like everything. But since she said no for both of them, she got the $1,800 on this year's. She got a credit. So her tax refund was going to be $2,000, which is completely, it's not. I'm just saying as an example.
Yeah.
But instead she's getting back $3,800. So she's getting all of it now. I have one client whose return I worked on today, and I haven't finished it, so I can't tell you the answer, but she made a little bit more, and last year of the first one, the $1,200, she got $76. So I enter in the 76 right now and see what, and then this year, I'm not sure if she made more or less than she did last year, but she got 76 for the $1,200 and nothing for the 6. If this was tomorrow, I'd be able to tell you how that will affect her return, but how, and then I got one guy that, an older gentleman. I have a few older folks that I do the returns, and he thought he knew he got the $1,200, and he said he didn't get the $600. And I said, all right, and we got it to close to done, and I said, look, if you got it, and you don't think you did, but if you did, and we file this, they're going to know that they gave it to you, and you're going to owe $600 back. So then he checked his bank account, and I told him when mine came up in January 4th. Everybody that I know, it was deposited on January 4th or 5th. And he went back to his bank and he found it. So he did get it, he just didn't know it. So.
Okay.
And the last thing I say about that $600 for folks who don't have online banking or don't check their bank statement, my $600 went in January 4th, I think it was. I got the letter saying, hey, your $600 is on the way, like 2 days ago. In February, what are we in, February 23rd? Like February 21st, maybe Saturday, that's how long it took for the letter to come saying your $600 is coming. Wow. So just because you didn't get the letter yet doesn't mean it didn't go into your account, so check it,
Right. And we got it. We did get one check, but it was mailed because they don't have our deposit information.
All right.
But so those take a long time. I know it was like my son, he got it right away, like you're saying, direct deposit. He just checked his account. But
And there's no delays in filing taxes or anything. It's still the same. It's business as usual.
No, there was a delay. They wouldn't accept anything until February 12th. So now there isn't for personal returns. There's no delay now. But there was because of the 600 stimulus package. It was done in the end of the year last year. So the IRS had to redo all their forms. And so that's why they couldn't. And in fact, I'm working on an individual that's a non-resident. He's in China, and he owned property here, sold it here. I had a non-resident tax return for him right now, and the IRS won't. So I'm getting not a warning, but a red flag on it that the IRS will not accept it right now and I'm sure it has to do with that. Well, it says probably mid-March I can file that return. So even though it's done and it's ready to be filed, I can't do a darn thing with it until the IRS will accept it, and right now they won't accept it. So there are, and that's just the forms I know about. There's probably other forms that have changes to them too.
I hope mine's just.
If it's a regular 1040 with a Schedule A or a Schedule E, you're good to go.
Okay.
Yeah.
Okay.
All right.
Good.
All right.
Thank you very
right
much.
on. Thanks for having me. I appreciate to see you guys.
yeah, great information. And if you have any questions or would like to reach out to us, my number is 805-878-5056.
And I can be reached at 805-714-8124. And thanks for watching.
Yeah, we'll see you soon.
To see more information, go ahead and click on that button, and you can reach me at 805-714-8124.
And my number is 805-878-5056.
Thanks for watching.
Yeah, we'll see you soon.
Bye.